Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known by many of you as Mr. Valuation. This video is actually part 2 of a series I did on constructing a dividend portfolio for retirement in today's challenging market. Now, I do want to put some qualifiers on this before I get too deep into part 2. Number one, this is how to build a portfolio in today's challenging market. In other words, in a more normal market where you had more, better choices, you'd want to start by finding the best companies you could possibly conceive, the dividend aristocrats, champions, things like that. In today's inflated market, it's very, very hard to find those kinds of companies. So if you were constructing a portfolio from scratch today, you have to take that into consideration. And we did that in part 1, where we created a list of about 130 plus companies that were dividend paying stocks that were attractively valued. Now that is a gross list, if you will. All right, so let's go ahead and take a look at that very, very briefly here. This is the dividend income at value. This is a group of stocks that had earnings yields that were above 6.5% to 7%. These were all companies that paid a dividend, and the dividend yields ranged from very little for the higher growth stocks all the way up to 8% and 7.5% for some of the higher yielding stocks. Okay, but the point is, as I often say, it's a market of stocks and not a stock market. So you have these 130 companies here, and if I just scroll through here a little slower, you can see they have different credit ratings, different dividend yields, different earnings yields, different characteristics in terms of how consistent they are, how fast they grow. Some grow faster than others, some grow slower than others. So you have all of these companies, but the point is, all this first step was, because I do believe buying value, no matter what the market environment is, whether it's challenging like it is today, or let's say a normally valued market where you have a lot of choices, or even a market like we had in 2009 and 10, where you literally could have bought almost any stock that you were really interested in. In other words, you had, the creme de la creme as a choice across the board, almost universally. Today, it's more challenging. You have to make some compromises. You have to be willing to look a little deeper, look a little further, because one argument that I make constantly, AKA Mr. Valuation, is you make your money on the buy side. And if you overpay, especially if you significantly overpay, which is what the market's asking you to do today, for even the best companies, you're going to end up with a very, very poor rate of return, a lot of risk, and you're liable to actually lose money in the long run. So you have to be very, very careful with valuation. So our first step was to create this portfolio of dividend income at value. And we came up with approximately 130 names with, again, all of these different characteristics. Now, the problem with a list like this, now if I'm going to sit down and I'm going to construct a portfolio for myself, depending on what your goals, needs, and objectives are, now I've got 130 stocks, but this is just my universe. Okay, this universe does not necessarily meet my own goals, needs, and objectives. So I do want to talk a little bit about how you should approach the portfolio construction. Number one is, I do believe when you go into this process, it's critically important to, quote unquote, know thyself. It's imperative that you as investors assess a realistic appraisal of your own emotional abilities, risk tolerances, tendencies, etc. In other words, if you're going to see if you can't handle a little bit of market volatility, then it may not even be appropriate for you to think about common stocks at all. But if you do that, if that's the case, you're also going to give up the opportunity to meet some of your goals and objectives. For example, there's very little available in fixed income today that could actually give you any adequate income. And of course, you also have to take into consideration the size of your portfolio. Have you saved enough over the years to be able to construct a portfolio that you can live off the income, or do you still need to try to find growth in your portfolio? You need to consider all these things, but regardless, before you can get into those nuances, you have to be realistic about who you are, how much risk you can handle. You also need to have a real assessment of what your goals and objectives are. How much income do you need? Is your portfolio capable of generating that? But then when all that's accomplished, then the most critical part is establish a plan, but then follow that plan judiciously and resolutely. That's one of the biggest mistakes I think people make, is they don't have a plan. They'll just buy stocks as a hodgepodge. They'll read something, watch a TV show, Kramer, get on the Motley Fool or, any of these websites where people recommend a stock, and then they'll go look at that stock and say, gee, I like that story, I'm going to buy that stock. Even if that stock doesn't fit their goals, objectives, needs, or risk tolerances, they're going to buy it anyway. But that's not a plan. Okay, that's kind of just, throwing a bunch of mud on the wall and hoping some of it sticks, which a lot of portfolio construction, unfortunately, is done that way. I see it all the time, when I'm dealing with individual investors. So you don't want to do that. You want to have a plan. Okay, you want to establish specifically what that plan is. How much income do I need? How much growth of that income do I need? How much risk am I willing to take? Do I need growth, or can I just settle for income currently? These are all rational questions that are primarily common sense based, because I do believe constructing a portfolio for your own goals and needs is primarily about common sense, and apply common sense. Okay, also recognize the market environment you're in. Again, we're a very challenging market today. So, if you're going to build a portfolio and you need to do that to start generating income, in other words, you don't want to leave your money sitting idle, you don't have the luxury of doing that, then develop yourself a nice plan, know specifically what your goals, objectives, and needs are, and then be realistic about investing in securities that can meet those specific goals and objectives. But the key here is to be realistic. And I'll tell you kind of a sidebar story. This is a true story, and it really broke my heart. I was very young, just starting out in the business, and I had a client, or a prospective client, come in and had $100,000 to invest. And the client proceeded to tell me that, they were getting ready to retire and they needed $30,000 a year of income. Well, it broke my heart to have to say to him, sir, I'm sorry, but that's completely unrealistic. I said, what it really boils down to is you've got about 3, maybe 4 years to live off of your portfolio if you're going to spend $30,000 a year before you've depleted your portfolio and you are broke. The point is, you've got to take what the market's giving you, and you got to be realistic about what that is. And we'll address that more a little bit later. My other recommendation when trying to construct a portfolio is diversify properly, not too much or not too little. Okay. Now, studies have said once you get past 18 stocks, that you've used up most of the benefit of diversification, and every time you add a stock after that, you start to dilute your potential return, etc. On the other hand, there are people that simply can't live with owning less than 20 stocks. They need 30 or 40, but I think there's a limit to that, because above all costs, I believe it's imperative that you construct a portfolio with a few enough names in it that you can follow those stocks and be able to have some knowledge. You don't need to have perfect knowledge. You just need to be able to, monitor the companies when they produce their quarterly reports and pay attention. Make sure the company's continuing to do well. Don't get focused on the stock price bouncing around, because, you can easily get whipsawed with that. Invest with an attitude of being a long-term investor. Recognize there's going to be volatility. And again, that goes back to what I said about point number 1, basically, know yourself. Are you willing and capable of living through some volatility? Like I always say that, great investors and great mountain climbers share a common understanding. They both recognize very clearly that the only way you're going to get to the next highest peak is to be willing to traverse the occasional valley that comes along the way. That's just how stock charts, they're called mountain charts. When you look at price charts, the stocks are constantly going up and down, daily, hourly, weekly, monthly, yearly. The key is focus on fundamentals first, as I've always talked about. And that's what we did when we attempted to do, at least when we created this list here of companies, that were reasonably valued, that had a dividend with them, because this is not a growth portfolio. Now I want to focus. This is strictly how to provide a portfolio for retirement or near retirement. Okay. And that's what this series is all about. Now, what I've then done is I've taken this list, okay, which is obviously a very comprehensive list, 130 companies. And the problem is I find it very difficult to manage that list. So what I've done is I've broken that list down into additional lists, okay? For example, out of that 130 companies, I put together 20 companies that were high yield, okay, that were yielding 4% or higher. The upper yield was 8.7%. The lowest yield was 4% or 3.99 in Huntington Bank shares. Now, I also want to point something else out, because I've had discussions about this. I've got financials, I've got regional banks here. Now, I can put the GIC sectors up here, the big GIC sectors up here. so you can see it, real quickly here. You've got financials, information technology, healthcare, real estate, another financial, but in a different area of financial, utilities, material sector, another financial, again, life and health insurance. You've got two of those here in this group of high yield, communication services, and again, a diversified bank and financials, IT consulting, a gas utility, tobacco companies, two of those are in here, integrated telecommunication services, another financial, but in asset management and custody banks. And then you got some MLPs here with oil and gas storage that have their own issues. Okay, so now, this is how I would work this. I want to be clear about this. Once I established my goals and objectives, if my goal and objective, because of the amount of money that I've accumulated, said I need at least a 4% yield, okay, then I would look very closely at these candidates. Okay, but I wouldn't only, as I'll get to in a moment, I wouldn't only limit it to these candidates, but these are the ones that are all going to give me the ability to meet that 4% yield if that's my objective. If my objective was 3%, I could go to some of these companies and I could mix them in, because then, let's say I also needed growth. All right, so I need at least 3% income and I need some growth. So I could look at the high yield stocks, and for example, I could mix, as I'll show you here in a moment, a company like British American Tobacco with 8% with an equal investment in a company that's, say, yielding 2% or 2, we'll just use 2% for easy math. That way, what I've got is I would average 5% if I put an equal amount of money. Half of it earned 8, half of it earned 2. I'd be making approximately 5% on that. So that would meet my target goal. So that's what I'm talking about establishing a plan and then following that plan and picking the right kind of securities that are going to help you meet that plan. So, I've got some high yield choices here that I can look at. Okay, then going beyond that, if my goals and objectives were, let's say I was looking for, higher quality and growth, I also then created another subgroup of this 130 where I organized the 38 companies that had the most consistent, historical records. And I'll show you that here in a little bit more. So these are companies that necessarily don't have high yields. Here I've got yields ranging from as little as only 0.5% up to almost 4% with Omnicom. But what you're really looking at here are companies that have a better chance for providing me dividend income growth, as you can see by this column here. So when I was looking to get some, let's say, you want to think of it maybe as a turbocharger to put a little, upside into the portfolio, but also have quality, have the highest quality I can with the most consistent records, then I might look, to this list some. All right, but then I'm going to also, I chunked another part of the list out. Now, there'll be duplicity in these lists. Some of these companies will, show up on more than one list is what I'm saying. But here, I put together a group that had 2.5% to 3% dividend yields. Okay, so now here I'm looking at, up to about 2.9% to 2.47. So I've got 2.5% to 3%. This I consider to be a sweet spot. This is significantly above the current market average. There's a lot of good quality companies in this list, but I can kind of use this as my foundation. I can, start structuring the corpus of my portfolio by looking at these companies that give me at least a 2.5% yield. Again, do I need income now or do I need income later? And again, I look at, dividend growth rates here. I'm going to get a little better dividend growth rates with companies that are on this list. Like here's the 5-year dividend growth rate. So that means if I invested in Eastman Chemical with a 2.5% yield, I'd expect that yield to grow somewhere around 8 to 10% a year. I'm not going to pick 10 as the perfect number. If I did Cummings, I would be expecting about 8% growth in this income. So this income, this yield would increase by 8% a year. That's how I'm structuring this to put these packages together here to create this portfolio. The next one I did, then I went a little higher up the chain, if you will, and I found 33 companies that basically gave me a yield of 3% to 4%. Okay, so these would be a little higher yields. You can see I was as high as 3.99. My lowest yield here was U.S. Bancorp at 3. We'll call it 2.99. But here I can get 3.5%. So again, I've got choices here, and I've got some good quality companies here. I've got plenty of A-rated companies and triple B plus rated companies that are, investment grade. I've also got triple B companies which are investment grade, and I've got a few that aren't. by the way, and there may be reasons to include some of those as well. But the point is, I've chunked this down. Now I got this group where I can say, okay, these are companies that are yielding 3 to 4%, and I can, look at those. And then, if I was an investor needing high growth, I still needed a lot more capital appreciation and growth, then I might look for companies that had the highest dividend growth, because that's where you're going to find companies that have the most upside potential in here. For example, if I went and brought earnings yield into this, I'm going to add that for you just so you see what I'm talking about. You're going to see here that these companies have some pretty nice earnings yields. Not all of them, but some of them. Even up here with HPQ at 11% earnings yield. Evercore, another financial with 8.5% earnings yield. But you've also got these double-digit dividend growth rates where these companies, you might, when you start examining them, you might look at the lower payout ratios. So what I've done is I've taken all this big list that I created, okay, and I've chunked it down into all of these smaller lists. Okay, and so now I'm going to go through those. So here's my big list of dividend income and value that I went through. And obviously, this would be very cumbersome to go through all of these companies, and it would be difficult to organize them. So, let's go ahead and look. So now I'm going to move here to the high yield stocks, okay? In this, portfolio, I've got a limited number of high yield stocks. And what I'm looking for here, these are the ones that I would use to turbocharge my income, if you will. Okay, these are stocks, again, if you recall, that have the higher dividend yields. Starting out with Altria here, or the old Philip Morris, the symbol still MO, the original Philip Morris, which, by the way, is going through some potential transitions and maybe even some merging going on here with this company. But again, I've got a company giving me a 7% dividend yield. And if I look at the long-term performance of this stock, I've had double-digit dividend growth from this company historically. And I can buy it at a very attractive valuation. And in addition to getting just good dividend yield, I've also got a chance to generate some very strong capital appreciation if this company simply moves back to a 15 PE ratio. Okay, so this could be a foundational, one of those stocks that I would blend with perhaps other stocks from some of these other lists that would give me the opportunity to get, very high yield and yet not forgo capital appreciation potential. If you notice here, the normal PE and the intrinsic value PE, the blue line and the orange line, are very, very similar. There's always a range of value, but we're looking here at a company that's, historically traded at a very reasonable range. Normal multiple has actually been closer to 16 over the last 5 years at least. That's what the normal multiple is. So, there could be substantial capital appreciation. So I could mark this as one of my 15 to 20 to 25 stocks that I would put, which gives me that high yield flavor. If I was really, really needing yield and I had to get as much yield as I possibly could, because that was what my financial situation suggested, then, I might have to look to things like limited partnerships, okay? Companies that you're primarily going to see those in the oil and gas sector. They typically come with a K1, okay, which a lot of people, struggle with that. That's not necessarily, the bailiwick of a lot of investors. A good example would be Enterprise Products Partners, Limited Partnership, EPD. As you can see here, this is using operating cash flow. Stock yield's 8.43%. It's extremely undervalued, as a lot of energy stocks are. Even if this stock just moved back to its normal multiple, which is actually a discount about 11 times earnings, you have the ability to make incredible rates of return by investing in this stock with an 8.4% yield. Its historical performance has been very good. The dividends increased by about 6.5%, 6.47%. To be specific, on average, using the 8 years here, the last 5 years, it's only been growing at about 3%. But you can see there are times when it still grew at 4 or 5%. This is because of the energy sector. My point is, this is a choice that you could pick if you really needed high income and you didn't mind the nuisance of things like, dealing with a K1 and so on. But again, you have to know, what you can deal with, what you can handle. This is simply another choice, and it's one thing that's available. It's a choice that's available to you if you so choose. You can look at names like Verizon, and I'm going to use adjusted operating earnings here. As you can see, the cash flow coverage is good. Verizon is very inexpensive with about a 4.5% yield. If I look at it from a standpoint of dividend growth, it doesn't necessarily give me the dividend growth that I would like, but it does give me some dividend growth. But I have a 4.5%. Again, I could blend this with something maybe yielding 2.5 or 3% and get my yield over 3%, but yet invest in something, as I'll show you here in a moment, in one of these stocks that have much higher dividend growth potential. So you've got, lots of different choices here that you can look at, that of some very undervalued stocks here that have good yields. Here's Prudential with a 4.34% dividend yield, an earnings yield of 11.7%. You can buy it at 8.5 times earnings, which to me is a steal for this A-rated company with, very little debt. Now the market has been valuing it at this 8 or 9 times earnings for quite some time, but there's a very high possibility, at least, that one day this stock will get back to where the market starts trading it at a 14 or 15 multiple. Regardless, this stock looks very, very inexpensive here, and it's one that you could add and, get yourself up to a 4% dividend yield. So, you've got choices. Here, I'm going into the consistent ones. Now, what I'm going to do with this particular group is I'm going to go through a lot of stocks here, because what I want you to see here, these are companies that have very, very, like Anthem has very, very consistent historical growth, typically at relatively high rates. All right. So, these are, usually they have good credit ratings, most of them. This would be my favorite list of companies that I would try to build the nucleus of my portfolio. Now, in the case of Anthem, you've only got a 1% dividend yield. Okay, but you've got, growth potential. The dividend growth for this company is averaged over 15% a year. So again, you mix this in with some slower growth to give you an acceleration in your growth rate, but it's going to lower your overall yield because it's not a high yield stock, but it's a very high quality, consistent stock with capital appreciation potential. Here's Jack in the Box, and the dividend record is not stellar, yielding about 1.5%. I'm just going to go through these quickly. JP Morgan with a 2.3% yield, very consistent since coming out of the Great Recession. Here's Prime America, which is a life and health insurance company, really an excellent historical record. I do want to quickly show you it has an awesome dividend growth rate, but I do want to get rid of some of the crazy numbers. But the dividend here has been growing at 15 to 20% a year or better. The stock is very inexpensive. It's an A- rated company. It's an extremely high quality company. You've got only about a 1% yield here, but again, you've got very interesting capital appreciation and growth potential where you could get double-digit rates of return and a growing dividend income stream from a company like this. I'm going to go through these a little quicker now. Here's, Research and Consulting Services, SA Science Applications International Corp., 1.78% yield here. This group of portfolios is typically going to be lower yield and more growth potential. That's the key that I want to get at here. Now, not all of them, like here's the gas utility UGI, but it gives you almost a 3% yield, but a very nice, historically consistent dividend growth record. But again, if I was building a portfolio myself, I would be focused on this list, depending on whether or not, the client or myself or the prospect needed income, because you're not going to get the current yield out of this list, but you are going to get the better quality companies with the higher capital appreciation potential. And occasionally you'll find there's a few in here that do offer you a decent dividend yield, as I showed you earlier. But mainly here you're looking at growth and total return potential. Okay, so that's these are my consistent companies. These are the ones that I think just are the ones that you can sleep well at night with best, because they've provided such good, consistent historical growth. Here's Cigna, which has been a growth stock that is now starting to pay a dividend, and that dividend yield, right now the company's paying about $4 a share. This yield isn't totally correct because it hasn't caught up with the increase in the dividend. Here's McKesson, very low yield, but very strong growth, almost 15% growth. If I look at its historical performance, it's had really strong historical performance, even relative to the market, and it's actually produced more dividend income than the market, even though it has a low yield. But look how the yield has grown historically over time. And that's the key to this particular group of companies here. We've got very good, consistent, moderate yielding, maybe, like here's Amerisource, slightly above the current market, but again, a company with great yield and good valuation. So this can be utilized to turbocharge the portfolio, even if you're looking for more income, where you get more dividend growth, where you mix this up with other stocks. Here's Bristol Myers, which offers a 2.8% yield, and so on and so forth. Intel, which I talked about recently. Archer Daniel Midlands is a cyclical. It does give you a little higher yield than others, and it's very reasonably priced. All these stocks are reasonably priced. Now, many of them still need to be researched. Like, I don't know much about Cabot. Cummins is one that I know a lot about. The stock has just recently come back into fair value. So you've got lots of choices here. Bank of Mellon, New York. You've got, as I showed you in part one, you've got numerous regional banks and asset management and custody banks like Bank of New York Mellon here, which obviously is a large bank, not a regional bank. So I don't want you to think I said that, but there's just so many choices here of good quality companies with pretty decent, historical records. Then you go into the 3 to 4% yielders here. You can make some from, the list I just showed you. You could sprinkle in with some of these 3 and 4% yielders here. And again, you've got, some really good companies. Here's one of those regional banks I talked about. The regional banks have done better since coming out, but there's so many of these. I was asked this question, which one would I pick? Well, you might want to pick a regional bank that is in your region, that is, if you, depending on where you live, that actually serves your region, where you can know a little more about it and, be able to even observe and see how the bank is performing. You've got Amgen here at a 3% yield, a very strong valuation, tremendous growth potential. There's another regional bank, Huntington Bank shares. Notice that all these regional banks have very, very similar historical looks. They all got caught up in financial debacle. Here's Merck. Pharmaceuticals stocks are beginning to grow again. This is a spinoff from Dow Chemical, Chemours. A little bit cyclical, offers a 3% yield, but it's got, it's forecast at least for the next several years to give us good growth. The longer term growth rate is extremely high. And, I'm not sure that that's really accurate, but one thing you can also do when you see something like that is you can go to a site like Yahoo and check their growth, and Yahoo says 27% a year as well. So this could very well possibly be a great opportunity to buy a 3% yield stock that it's not investment grade at this point because it's a spinoff. It does have relatively high level of debt, but the company also has good cash flows. And let's look at cash flows real quick to make sure. Yes, they have strong cash flows supporting both their dividend and their growth. And let's look at free cash flow. And free cash flow has been covering the dividends, expected to cover it significantly going forward. So, there's a lot of opportunities here for you to go in and construct a portfolio that makes sense for you. That's the key point here. Back to another pharmaceutical, Pfizer. This one I'd be a little careful with relative to what might happen going forward, because obviously this has benefited this fiscal year from, the vaccine and the COVID. It's got an 81% growth in earnings, but it does offer a 3% yield. It does offer almost a 7% earnings yield. So, it might, again, be one that you'd want to consider. Again, here's another regional bank. Which one would you pick? The one that operates in your region might make the most sense for you. So the bottom line is, if you're constructing a portfolio, you want to go into, you want to look at your list and look at the different kinds of companies that have these different characteristics and try to blend the portfolio so that it meets your own goals, objectives, and needs. I want to talk a little bit about diversification. I prefer 20 to 30 stocks, maybe 25 would be a happy medium, because that way you have enough companies to protect you from one company blowing up on you inadvertently. That won't destroy the whole portfolio, but then you have a small enough universe that you can really build up a knowledge and keep track of them with the quarterly reports. It's critical to manage these portfolios. So, there is no right. I think this is the key point that I want to kind of close this video with. There is no right answer. The artificial constructs that a lot of people in finance like to, promulgate, things like, the 60-40 rule, 60% stocks, 40% bonds. Well, maybe that makes some sense for certain investors, and maybe it makes sense if you had what I would call reasonable levels of interest rates. But at today's low rates, it doesn't make a lot of sense to me to have a lot of money in bonds. I'd be trying to buy high quality dividend growth stocks. But, also the best dividend growth stocks are not necessarily available. You can look to these stocks and maybe one day upgrade the quality of your portfolio by investing in some of these premier, blue chip dividend aristocrats and so on, if and when they come into attractive valuation. The one beautiful thing about building a stock portfolio, it's like one of my mentors told me once, investing in stocks is like investing in a horse race, but the difference is you can change horses anytime during the race you want, including up to the finish line. So you've always got flexibility, but don't do it too much. But now, the reality of this is use common sense. Look for stocks that meet your goals and objectives, blend that portfolio together. Another question I was asked that I want to quickly address is what percentage would I put in? Well, that's where your creativity comes involved. Simply apply common sense. Accept the fact that there is no right and wrong answer. There's the right answer and wrong answer for you, but there is no universal correct answer to this type of a process. And it is a process. It's a process that you can be constantly working with and tweaking. But for example, let's say you were the investor that really needed current income the most. Well, you could, put half of your portfolio in these high yield stocks and build maybe, say you were going to have a portfolio where you're going to have, say, 30 stocks. You could put 10 of them, you could put 50% of your money in 10 of them, and then the other 50% spread around over the other 20 and overweight your portfolio into the higher yielding stocks. But then you'd have to watch those stocks very carefully. There's all kind of creative ways to do that. You can equal weight, put 4%, in each of 25 different names. You could put 5% in 20 names. Again, you can mix it. You can overweight. You can put 5 or 10% into the stocks where you have the highest conviction. All of that trying to meld your portfolio into a portfolio that specifically meets your goals, objectives, and needs. And it's one that you've built with a plan, where you've constructed it, where you know specifically what you believe the portfolio is capable of generating, and then you monitor that continuously. As I always say, there is no substitute for continuous monitoring, research, and due diligence. In short, once you build your portfolio, it's imperative that you manage that portfolio. But again, all of this whole series was predicated on the idea that this is a very challenging market, and that if you were trying to build a brand new portfolio today, this is the kind of process and the kind of thinking and the kind of planning that I believe you should apply. It's more about common sense than it is trying to follow any rules or any, specific pattern, or platform. Build the portfolio that's best for you, and build the portfolio that you can live with. Be a long-term investor, focus on value, buy the highest quality you can, and make sure you're building a portfolio that you can hold on to and live with. And the final comment I want to say here, I've addressed all of this, the idea of building a portfolio that did not require you to harvest profits. In other words, a portfolio that was able to generate the amount of income that you needed to live comfortably on or to maintain your standard of living. If you don't have enough assets to do that, then you have to think of portfolio construction differently. What I've put forth here in this series. Anyway, thanks for watching. I look forward to talking to you guys again real soon. If you like this video, give me a like, ring the bell, subscribe to the channel if you haven't already, and I'll be talking to you again very soon. Thanks, guys.